Hey guys, Akil Stokes here. Welcome back to the Trading Coach Podcast. Today we're going to talk about the correct way to measure performance and also talk about why in trading, right, it's really cool, but you don't have to do more to make more. Now, if you're not watching on Spotify or YouTube, this is a video version, so get over to those platforms or whatever other platforms share the video versions if you want to see me. Probably not going to be as active today as I just finished a hill workout. My neck's bothering me a little bit, but I had the topic on my mind and I wanted to get it to you guys as soon as possible. And really, that's the point of the Trading Coach Podcast, just to go back in time a little bit for you guys that are new. Before I was coaching, before I was podcasting, before I managed money, before I was a successful trader, I was pretty bad. And I remember my coach and mentor encouraged that I do a journal or a diary to get out my thoughts and learn from my mistakes and all that fun stuff. And although I fought him for a little bit on doing it, once I did it, I found it to be very helpful. And I made it public because of the whole accountability stuff. And lo and behold, the internet loved that I was sharing how bad I was because I was bad. It was typically not seen for a trader on the internet to be sharing how bad they were. You guys were bad too. And it was a place where we could all be bad together, right? And through those years, obviously, I got better, I developed, and I kind of stopped doing it. And I felt kind of this empty void for a few reasons. One, it was my way of reflecting. It was my way of learning, admitting and understanding what I was doing wrong and coming up with solutions. But it was also a way for me to impact traders out there. And that was something I did before I got into the coaching. And once I got into the coaching, although I love working with our Tier 1 members, there's a lot of traders out there, aspiring traders out there that just can't afford the programs that we're doing. And that was kind of me at the beginning of my career. And I wanted to leave something for you guys once I pass or I'm done coaching, not to get too morbid and all that stuff, that you can continue to learn from forever. So that's kind of why the Trading Coach Podcast started. It wasn't because of the money, right? Despite me wearing my fancy blue shirt, right? If inside joke for you members that are here with every episode, it's because I actually love and find value in what I do, and I do want to leave a legacy that's important to me. So enough of that stuff. Let's hop into the topic at hand. So I had a conversation with one of our Tier 1 trading members, and I have it over here. I want to read to you the comment real quick, just to kind of give you a background. And we were talking about once you become successful at trading, the different routes you can take, and he was asking for advice on what do you think you should do and stuff like that. And there was a statement that really stood out to me. It said, because ideally, the more money in your account, the less the market has to move as long as you keep the right mindset. And I said, wait a minute, no. That is the wrong mindset, right? So this statement set off a handful of red flags and a lot of reminders of conversations that we had before. One of those conversations is about risk in trading, and that, many newer traders believe that, hey, I need to be more risky at the beginning stages of my trading because I have less money and I've got to do more to accelerate the growth of that money. And then once I have a lot of money, I should become less risky because now I'm dealing with kind of a bigger sum. And although there is some truth to that in a completely different way, that is the wrong way of thinking, right? You shouldn't risk a lot at the beginning of your trading career, right? Because you're more likely to blow it. One, you're more likely to blow everything because you're risking too much. Two, you're more likely to blow everything because you're risking too much at a stage in your trading when you're at your worst, right? You are at your worst in the beginning. Ideally, you should get better as you progress. Why would you want to be more risky when you have the greatest chance of blowing everything? So that kind of poo-poos that idea. The second idea is that it's a time versus money game, meaning that the more time I invest in the market, the more money I'll make. And in kind of the sense that we spoke about in the previous podcast, in order to make more, I have to do more. And when we say do more, that typically is thought of as I need to trade more. And then you have over trading, deviating from your plan, and blowing your account, right? You can see everything ends in blowing your account. So we want to squash that way of thinking. And the statement that the trader said to me about the market has to move less to make the same is kind of up a similar path as far as like these new trader myths that need to be debunked. And I want to start off by talking about kind of measurement in market, right? Because there are three ways to measure moves in the market, whether it's the stock market, futures markets, forex markets, right? We're typically looking in points, ticks, or pips, right? So think of points as kind of a brief refresher. Think of points as being like the big number. So if you're in the stock market and you're trading a stock that is worth $100, right? If that stock goes from $100 to $105, then it's commonly said that it moved 5 points, right? So think about points as being the number to the left side of the decimal. This might be right to you, but trust me, it's my left. To the left side of the decimal, right? The bigger number, the dollars, you can say. Ticks and pips, right, are numbers, the smallest numbers to the right side of the decimal. So think like pennies and cents, and in Forex it goes to like quarters and all that fun stuff. But think about it like if a market goes from 105.93 to 105.95, it moves 2 pips. And pips, although they are within the formula of how you calculate profit, pips, ticks, points are nothing but units of measure, right? They are just words that we've created to say how far it has moved from one thing to another thing. It's no different than centimeters, where if I move 1 centimeter to the right, that is the unit of measure. If I move 1 foot to the left, I know this is opposite for you, but deal with me. You can see how stiff I am, right? I've moved 1 foot. They are units of measure. And units of measure are used to help determine how much profit you made when you add in your position size. So again, I'm going to try to make this as basic and as slow as possible. Let's use just pips for example, right? So if I am trading a mini lot, which is $1, generally $1 per pip. If the market goes from 105.93 to 105.95, we have moved up by 2 pips. If I'm trading $1 per pip and we've moved up by 2 pips, do the math here. 1 times 2, carry the 1. We have made $2, right? Does that make sense? The market moved by 2 pips. Each pip is worth $1. 1 times 2 is $2, right? So that is, imagine you're trading with a very small account at the beginning of your trading career. Let's just say like $1,000 account, something like that. So let's move on to in the future, 5 years later. Let's say you're trading a $10,000 account. And instead of trading a position size of 1 mini lot, you're trading a position size of 1 standard lot, which is 10 mini lots. So that is $10 per pip. We'll take the same calculation, 95.93 to 95.95. The market moved up 2 pips. Now, instead of kind of $1 by 2 pips equaling $2, now it's $10 by 2 pips, which equals $20, right? So this is the concept that the trader was thinking about when he said, hey, as my account gets bigger, I can shoot for smaller moves to make the same amount of money. Makes sense? Hopefully, maybe you can slow it down and watch it again if that's the case. So here's the problem with that way of thinking. We are actually sabotaging ourselves, because the impression that I got from the trader is that the mindset is not thinking about kind of how much movement I should get per trade, which is how we should be thinking, and I'll touch on that in a little bit, to how much money I should get per trade, which is going to significantly reduce our profit potential. So when we're trading, and this is my opinion, there's many different opinions out there, so, kind of find whichever one fits for you. But in my opinion of traders, right, we are predictors of movement, meaning that our job as traders is to look at a price chart, or, just speaking from the technical perspective, look at a price chart, identify what the market is doing, predict which way we think the market is going to go, and then make an even more detailed prediction of if the market goes that way, then where is the next stopping point, right? After we've made that prediction, then we have, we decide on our entry and we get involved. And essentially we're left with 3 things. We're left with an entry right here, a stop loss where we're out of the trade if things go bad, and a potential profit prediction where we think price is likely to go if it moves in our favor. And the predictor of profit is based off a technical reason. It could be a level of structure, it could be an indicator, it could be an even handled number, a Fibonacci, volume, like whatever is your cup of tea. The fact is, we're saying that, hey, I think the market has the potential to move this much off of this move, right? So you can see position size and everything is secondary. That just comes into account when we're measuring our risk and making sure that we're staying within those levels. So if we're basing our trading purely off this, as we get better at trading, we open up the opportunity to make more money. What do I mean by that? Well, let's say that projected move that we predicted was 20 pips away on this individual trade. Let's take our first example, right? I'm a new trader, $1,000 account, whatever like that. I'm trading one mini lot. And let's say this trade goes in my favor. So we go 20 pips to the upside, right? 1 times 20. That's my calculator face, right? We've made $20, right? Because we've made $1 per pip, right? Change in a unit of measure, excuse me. And we've gone up 20 pips. We've made $20 on that trade. Now let's fast forward to years down the road, 5 years down the road, we have our $10,000 account. Instead of one mini lot, which is $1 per pip, we are trading a standard lot, so $10 per pip. We identified the same type of move, prices here, we expect it to go to here, it's 20 pips away. We've taken the same exact trade, 20 pips, but now instead of making $20, we've made $200. Why? Because we're trading with a higher position size. There's more risk as well. Again, that's what you can take into account, but we're trading with a higher position size, right? And that's how we should progress. We should be looking to do the same thing on the chart, just with bigger size as we grow. Now, to go back to the other way of thinking, if we're just shooting for a specific monetary figure, let's go back to that first example, right? Where I'm trading one mini lot and my goal is to make $20. So I know that the market has to go 20 pips to make $20. It does it. Woohoo, made some money. 5 years later, if I still want to make $20 and I find the same trading opportunity, well, now I'm taking my trade off after we move 2 pips because standard lot, $10 per pip, we move 2 pips, that's $20, right? I've made my quota, yes, but I've left 18 of those pips on the table. So I understand the thought process of like, hey, it takes less movement to make the same amount, but the goal shouldn't be to make the same amount, right? The goal is to make more. This is the whole power of compounding, right? We go through that 3 to 5 year period where we're doing everything right and our money is like slowly trickling up because we don't really make much in the beginning. But after we reach a certain level, we can increase our position size. Now we're making monstrous returns, but we're doing nothing different in our trading, right? Think about it like this. If you had to do a lot of positive work to grow your account in the beginning, why would you change what worked to get you to where you are once you get to where you are? It doesn't make any sense. So we can't judge ourselves like that. We have to judge ourselves by taking the amount that the specific trading opportunity has to offer. So when it comes to judging your trading, and especially when you're in the phases where you're kind of doing your back testing, you're acquiring your numbers, it's very important to analyze your numbers in percentages, right? Pips are great. Again, pips are the unit of measure. They're going to tell us how much we were able to capture from the market. When we combine pip with whatever our position size is, we can kind of get what we make from the market. But measuring in percentages is the key, because if you can make 5% with if you can make 30% with a $1,000 account, you should be able to make 30% with a $10,000 account, 30% with a $100,000 account, doing nothing different. And that is the goal. If anything, you get a little bit better because you spent time in the market. You get better with entries, you get better with predictions, you cut your losses shorter, you add new strategies. So we just improve on all of the metrics that help us make more money. And at the end of the day, that's the goal, to make more money. So I hope you guys enjoyed the podcast. I felt like I'm all over the place. Again, I'm not 100%. The neck is really bothering me, but hopefully it made sense. If it didn't, just let me know and I'll revisit it. And make sure you revisit past episodes of the Trading Coach podcast. There's almost 1,100 available. I'm not saying you have to go back to episode 1, although you can if you want to, but pick out 10, use it like an encyclopedia, enter Trading Coach podcast, back testing, Trading Coach podcast, risk management, Trading Coach podcast, psychology, whatever topic you want to hear about, and I guarantee you'll find an episode on it. And if you can't, just hit me up on the socials, let me know, and I'll do an episode just for you. All right, until next time, plan your trade, trade your plan. Gonna go massage the neck. Akil out.